question number three. Question number three. Question number three, boy. So it is May 2021. May 2021. May 2021. Question number three, boy. Question number three, boy. We are told there, Bamboo Limited is currently unlevered. So Bamboo currently, Bamboo is unlevered, meaning zero debts, no debts. Currently, zero debt, no debt. Okay. So you're told that the firm is expected to generate a constant EBIT of shillings 20 million per annum in perpetuity. So we have Bamboo, the unlevered firm is basically able to produce 20 million every year, up to when? Up to forever. N is infinity. So 20 million per annum in perpetuity. Great examiners give a lot of information. So the current market value of the firm is 80. The current, can somebody in this case here help me by sending this paper? I can also do it. So send the paper to AFM, paid AFM helicopter, like that. Great. And then I'll be able to go back to my question. So please confirm that you have received the paper. Confirm you have received the paper. Confirm you have received the paper. Great. Thank you very much. So please go straight away to question number three. Go straight away to question number three. Go straight away to question number three. Question number three. So we are told here the firm's current market value is 80 million. So it means that Bamboo's value of equity is 80. Can somebody tell me, why am I calling this VE, value of equity, and yet the examiner talks of the total market value of the firm? Why am I not calling it VT? Why is it being called VE? If I could help you answer this, remember this firm is unlevered. So it means that whatever value that the firm has belongs to equity holders, belongs to equity holders. Great. So you're told the management is considering undertaking an expansion activity by use of debt financing. The firm's financial analyst has estimated that the present value of any future financial distress is 8 million. However, the probability of distress would increase with the leverage according to the following schedule. So you can see value of debt, we can see probability of financial distress, we can see pre-tax cost of debt. Pre-tax cost of debt is what we call KD. This pre-tax cost of debt, if I were you, I would have straight away written up there that pre-tax cost of debt, this is what we call KD. You can even add there KD before tax, KDB. Now we have KDA and KDB, cost of debt before who? Before taxation. Very important. Now, corporation tax has been given there as 30%. They want us to give them, number one, the current cost of equity and the WACC of the firm. Is there anybody who can do that question very fast? Right now, we give that person 1,000 bob through M-Pesa. Anybody who can do that question very fast, we give them 1,000 bob. Just put up your hand. If you think you can calculate the current cost of equity of this firm, I give you a chance. Anybody who's putting up their hand so I don't waste people's time. Mr. Naita, yeah? So Mr. Naita, I'm giving you exactly 1 minute. Try redeeming that 1,000. Redeem the 1,000. Right? So there's a chance in this case here that is being given to Naita alone. So in this case here, he's going to give us part 1. He's going to give us KU, which will be exactly equal to show like that. Somebody must have heard about this. So you're going to get, the examiner wants you to get cost of equity and the WACC. But fortunately, Once you get one of them, then you'll have gotten the other. Cost of equity of an unlevered farm equals WACC of unlevered farm. K equals can I give my answer? Imeenda hivyo. So who should we give this 1,000 bob? Who should we give this 1,000 bob? Who should we give this 1,000 bob? Is it Naita or Shem? We shall overcome. Let's see, ladies and gentlemen. Here we are. You see, a good student will tell you one thing, that when it comes to farm valuation, when you want to value an organization that will be getting an income forever, we normally take, you guys told me, take the annuity amount, you divide by what here, somebody? You divide by R. Is there somebody who is able to remember this formula? This formula where we take A divided by R whenever we have got cash flows we are receiving every year indefinitely. Yes. So the same here will be like this. So value of equity, the annuity income is the EBIT, right? Our cost of capital here is KE. Our cost of capital is KE. Now listen, ladies and gentlemen, even if we don't have interest, just in the formula, you can just include what here? Interest there, although we know that interest will be zero. Interest will be zero. And then the question has got what here? The question has got taxation. The question has got taxation like that. What am I doing? I'm looking at how much income will the equity holders be getting. Equity holders get what we call profit after tax. And then I capitalize this. I divided this with KE. Ladies and gentlemen, these guys have given me the value of equity. They've told me value of equity is 80 equals, we know what EBIT is. EBIT is 20. How much is the interest? How much is the interest? How much is the interest? The interest is zero. The interest is zero multiplied by 1 less tax. 1 minus tax, 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 0.7. I'm so sure the other question that I did for you as regards this never had tax, right? But this has got taxation. We have tax of 30%. So 1 minus 0.3, 1 minus 0.3 gives me 0.7 divided by, this is what these guys want. They want us in this case here to give them cost of what? Cost of equity. They want us to give them cost of equity. All right. All right. So try making cost of equity the subject of the formula. Quite easy. So if I extend this a little bit, this is what I shall get. 80 equals 20 times 0.7 over cost of equity. Then I'll come and say here, 80 equals, this has to be 14, right? This has to be 20 times 0.7 is 14 all over cost of equity, all over cost of equity. And I've seen where my two friends have lost some kismat there, right? So 14 over 80 times 100, we shall overcome. That is a language in capital letters. So 14 over 80 times 100 gives us what figure, somebody? 14 over 80 gives us 17.5%. Please read the question again. Read the question again. If you read the question again, you'll bear witness with Mwalimu what exactly they need. You'll bear witness exactly. You know, they want us to give them the current cost of equity and the WACC of the farm. The current cost of equity and what we call WACC of the farm. WACC of the farm. So remember here, they have not told you to use Modigliani, no. Here they simply wanted you to use the concept of what here? Farm valuation. Farm valuation. Farm valuation. They wanted you to use the concept of farm valuation. So in this case, ladies and gentlemen, once you have the cost of equity, then getting the WACC is not a big thing. Is not a big thing. Getting WACC is not a big thing. My K here will always be equal to the cost of equity of unlevered farm equals WACC of unlevered farm. Therefore, WACC of unlevered farm is also 17.5%. Is also 17.5%. I'm so sure there must be very many of us who got this thing correctly, although now because we normally mark and reward students on the basis of what they have written down, so nobody gets that present. So we look at number 2 now. So number 2 of this question, they want us to use now the pure Modigliani and Miller with the tax. This is the MM2 now. With the tax model, determine the optimal level of debt. I love this so much because anybody who talks of Modigliani Miller 2, that is a no-brainer really. I'll be able to get this without using brains at all. I will be able to get this without using any brains at all. How do I get this without struggling at all? I know the fundamental principle of MM2. I'll write this in capital letters. My own. I wish you could see what we brought up there. We say the Q equals WACC of unlevered farm. And therefore, WACC of the unlevered farm is also what here? 17.5%. It's also 17.5%. Are we together up to there? Right. So go to MM2. So the MM2, the fundamental principle is that value over a levered farm equals who? Value over a levered farm. Value of a levered farm equals who? 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 Pata potea. Value of a levered farm equal. Great. These guys are bright. These guys are bright. Nyinyi mshapita jana, hata sio juzi. Jana mlishapita kitambo kabisa. Kitambo kabisa. So they're telling me that as per Modigliani Miller, to get value over a levered organization, there is always a big advantage when, in this case here, you've got what here? When you've got debt, you'll always have a lot of what here? Advantages. Your value will be bigger always. Your value will always what here? Be big. Great. So value of a levered farm equals value over unlevered farm plus what here, somebody? Plus DT, like that. Plus DT. Value of unlevered farm plus DT. Value of unlevered farm plus DT. Now I hope you're able to see my board very well. Are you able to see my board better, or would you want me to increase the font size? Equals hour. So then in this particular case, we don't have one debt amount. We have several of them. So what I'll do is to come and mention their debt levels. So the debt levels have been given to me. I'm able to see the value of debt there. So I can see the first amount there is 2.5. The second amount there is 5.0. The third amount there is 7.5. The fourth amount there is 10. We have 12.5. We have 15. We have 20 like that. Now, is there somebody who knows what the value of unlevered farm is in this question? What is the value of an unlevered farm? Great, it's 80. It's 80. Value of our unlevered farm is 80. So I'll talk of 80 throughout. 80 throughout. So like now here, the first value will be 80 plus the debt amount. The debt for the first scenario is 2.5 multiplied by the rate of tax, which is 0.3. Could you kindly give me the first farm value? What is DT? DT is debt times tax. DT is debt times tax. That tells me that Winnie, you haven't watched some videos. You haven't watched some videos. So Winnie will get 2 strokes of the cane immediately after this class. Or I punish her by asking her to come to school with the parent, right? There must be some punishment. There must be some punishment here. So a representative value of this farm, which is now levered, which is levered, 80.75. Thank you very much. 80.75. How about the second one? Most of these metrics will remain the same. The only thing that will be changing is the debt level, debt level. So the second one will be 80 plus the debt here, which is 5 times 0.3. Please give me a figure. Please give me a figure. So I hope you guys are able to follow that. It's only the debt which will be changing. All the other metrics here will remain the same. So then we have here 81.5. Thank you very much. 81.5. So we go to the third one. It will be 80 plus 5. And then the good thing with this question is like these examiners are not very creative. Whenever they test us this concept, they bring the same type of question throughout. The same. I can even do this with my eyes closed. So 80 plus, not 5, but 7.5. 7.5 times 0.3. Please give me an answer. 82.25. 82.25. And then we have here 80 plus 10 times 0.3, which will give me what figure? 82? No. 83. Thank you very much, Meshak Kimitei. 83. From there, we have 80 plus 12.5 times 0.3. Is there somebody who already has this figure? 80.03. I refuse. I refuse that. It has to keep on increasing because the more the debt, the higher the farm value. 83.75. Then we have the second last. It will be 80 plus 15 times 0.3, which will end up giving me what figure? 84.5. I love that. 84.5. And then lastly, we have 80 plus 20 times 0.3, which will end up giving us what figure? Somebody here? 86, I'm told. 86. So then in terms of optimality, you know, we are in this world to increase our farm values. Even yourself as an individual, you are supposed to be increasing your value. So in this case here, the very best value is always the highest value. So this 86 is the best value. And therefore we are recommending to this organization to go for a debt of what year? A debt of 20. So optimal debt is 20. Optimal debt is 20. The highest, the one that corresponds to the best value. The best value. Is that okay, somebody? Is that okay, somebody? Somebody, is that okay? They are not talking to me. Because if you look at the question, really, what was the question asking about? The question was asking about, look at part 2, using the pure Modigliani and the Miller with tax, determine the optimal level of debt. MM2 told us to get out of our way and borrow as much as we wish, because the more that you borrow, the more you increase your farm value. Thank you very much. Look at Roman 3. Evaluate the firm's optimal capital structure when financial distress costs are included. Pretty similar to this. So in this case here, they want us to give them farm value with distress costs. We normally say value of a levered farm will be equal to value of an unlevered plus DT minus present value of financial distress. So value of a levered farm equals value of an unlevered farm, right? Plus a DT minus present value of financial distress. Please write this in full. Write this in full. Write this in full. Present value of financial distress. So whenever they talk of financial distress costs existing, you always think of MM2 now with this rider here, with this additional metric, additional term. Great, great. So then, ladies and gentlemen, what I would want us to do, we must always begin with debt. We must always begin with debt. It's MM4. It's MM4, but you see, it is coming from where? It's building up from MM2. It's building up from MM2. So this one here, you're right. This is MM4, but it's building up from MM2. So you take value of unlevered farm plus debt times tax minus present value of financial distress. Present value of financial distress. Have you been able to write it like that? Have you written that? Have you written that? Great. So then the very first thing we shall do is to come and write. Hata kama understand chochote, always unaanza na kuandika debt. Unaandika debt mbio kama mimi, the debt amount unaandika mbio kama ona mimi nimeshamaliza. Ona mimi nimeshamaliza debt amounts. Yeah, financial distress ni MM4 years. But remember, as I told you, it comes from where? Just an extension of MM2. It's just an extension of MM2. So is there somebody who has been able to write these debt amounts? Yes, yes, yes. Thank you very much. Now then what I would want you to do is to come and give me the finance distress costs. Give me the finance distress costs. Somewhere up there, they're given us the finance distress cost, true or false? If you can remember, there is a place they gave us the finance distress cost ya pesa ngapi? 8 million, right? Financial distress cost here, 8 million was given to us. 8 million was given to us. $8 million was given to us, yes. 8 million was given to us. If you remember, there is an 8 million somewhere. 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 8 million somewhere. 8 million somewhere. So, ladies and gentlemen, one thing that you're supposed to know is that 8 million will be cutting across each of these debt amounts. So it will be 8 there, 8 there, 8 there, 8 there, 8 there, 8 there. How many? 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Like that. Now, there is something that so many students really leave out. These people will always give you probabilities of financial distress at each of these debt levels. They'll always give you. 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 They will always give you probabilities of finance distress. Always. Are you able to see those probabilities there? Are you able to see the probabilities there? Yeah. They have given us probability of financial what year? Distress. So when you see probabilities against figures, what should you do? When you see probabilities and figures, how are we? Tata, you multiply. Yes, you multiply. So the first one of 2.5, I can see the probability there is 0. Probability there is 0. Probability there is 0. And then I have, ladies and gentlemen, the next one, probability of financial distress there, I can see 1.25%, 1.25%, so times 1.25%, all right? So I can see 2.5% there. I can see, ladies and gentlemen, 6.25%, 6.25%. Then we have 12.5%. Then we have 31.25%. Then we have 75%. So could you kindly give me these figures? I know some of them could be very small. But you see, there is no way a probability can be, like most students here were taking probability of 31.25. So you take 8 times 31.25 without percentage, and then you call me, you tell me, Mwalimu, I've passed. How do you pass when you have forgotten the fundamental principle of probability? Probability has to be point something. Is that numerical value that falls in between 0 and what here? 1. Don't fall onto simple traps of the examiner. This is a very simple trap, right? So the first one is 0. How about the second one? That will come later, my own. That will come later. There is no relationship between financial distress and the KD. KD is the rate of interest. KD is the rate of interest. This is not interest. Financial distress is when, for example, auctioneers are coming on the door. Financial distress is when you are, for example, going to defend yourself in court when you have been sued by debtors or creditors. All right. So somebody tells me this is 0.1. 0.1. 0.2. Thank you very much. Remember, these figures are in millions, right? So we have 0.5. Thank you very much. Thank you very much. Thank you very much. All right. And the next one is 1. 2.5. Thank you very much. 2.5. Thank you very much. And the last one will be 6. 6. Now, after that, now you can come and put in the formula. We know that value of a levered farm equals value of unlevered plus DT minus present value of financial distress. So remember, the 8 million was a PV. Already they are discounted. They always discount for us. So remember that these are present values like that. So do we have value of an unlevered farm in the entire question? Do we have value of unlevered farm in the entire question? Yes, it is 80, and that is going to be the same throughout. That is going to be the same throughout. The same throughout. 80, 80. That doesn't change. Plus, are you able to see the debt equivalent debt amounts? Are you able to see the equivalent debt amounts? Yes, they're here. 2.5. We have 5. We have 7.5. We have 10. We have 12.5. We have 15. We have 20. These debts must be multiplied by what here? By tax. Debts must be multiplied by taxation. Debt must always be multiplied with what here? With taxation. And then now you less the present value of financial distress. So you less present value of financial distress, these things that we have here. So we have 0, 0.1, 0.2, 0.5, 1, 2.5, 6. So I'm so sure, ladies and gentlemen, if you did this exam, I'm 100% sure that this question you would have gotten 100%. Right? Up to here, that is. Yes. Thanks, Andele. $80.75. Thank you so much. Thank you so much. So I'm being given a figure of 80.75, 80.75. All right. Then we have 81.4. Somebody is giving me a figure of 81.4. 82.05, 82.05, 82.05. Thank you very much. $82.5, 82.5. Thank you very much. We continue like that. $82.75, 82.75. Thank you so much. Second last. $82 exactly. The last one here, second last, I mean, is $82 exactly. Continue like that. What is the last one? The last figure. Somebody tells me it is 80. The last figure is 80. The last figure is 80. The last figure is 80. Please go back and read the question again. Go back and read the question again. So the question, ladies and gentlemen, here wanted us to evaluate the firm's optimal capital structure. So don't start advising us here. No, this one here was a very detailed question. They want us to evaluate the firm's optimal capital structure when financial distress costs are included. They're not asking about the optimal level of debt. They want optimal capital structure. Optimal capital structure is that capital structure whose WACC is lowest. Optimal capital structure is that capital structure that has the lowest WACC. So then that means, ladies and gentlemen, that you must move here very fast to give me the weights, specifically weight of equity and the weight of debt. Weight of equity and the weight of debt. Weight of equity and the weight of debt. Right? So in this case here, remember that for us to be able to get WACC, we normally talk of weight of equity, cost of equity, plus weight of debt multiplied by cost of debt after tax, after taxation, cost of debt after taxation. So KD Mayom, this one is the pre-tax cost of debt, right? But the thing that very many students were not able to do here is to get the weights. So if you got this kind of a question on an exam, what do you think in this case here would have you done for you to be able to get the weights? Can somebody talk to me? What shall we do for us to be able to get the weights here really? Weight of equity and weight of debt. VE over total value of the firm, quite a good trial, but no. Yes. But how do we get, in this case, your value of the unlevered firm? Mengich had a point, but let me give you 1, 2, 3 minutes for you to be able to refine your answer. How do we get the weights there, somebody? How do we get the weights there, somebody? How do we get our weights here, somebody? How do we get our weights here, somebody? Somebody does not want us to be 1 plus D. I don't understand that. I don't understand that. Now, the first thing that I expected you great students here to tell me is that, you know, already we have the total value of the firm. These are the total firm values. And if I have here the total firm values, we know that total value will always be equal to value of equity plus value of what? Debt. Great. And then we happen to be having what here, somebody? Value of debt. This is the VD. So then the first thing that we need to do here is to come and ascertain value of equity. Myself, I'm very lucky because I can come and create, writing spaces for me is not an issue. So then out of this formula, what do you think shall I do to be able to get value of equity? I shall make value of equity the subject of the formula, which will be value total minus VD being equal to value what here? Value equity, being equal to value equity. So then value equity here will be equal to what? Somebody give me the first value of equity. Perhaps because of your revision, you can talk of 80.75 minus what here, somebody? 2.5. So first of all, I want to get value of equity throughout. I want to get value of equity throughout. Let's try to understand this question. This last mile for you is very important. Very important. If I were you, questions that you are doing currently, I'll have to look at them again. Later on when I'm alone, I'll reach home, look at them again and again and again and again, right? So let's see how many students are able to get these things correctly. So what is the first value of equity? What is the first value of equity here? What is the first value of equity? What is the first value of equity? 77, first value of equity. First value, that seems so big. 78.25. Thank you very much. How about the second one? How about the second one? How about the second one? 76.4. 76.4. Thank you very much. 76.4. Using this formula, value of equity equals total value, which is this one. This is the total value. Total value. Total value minus value of debt. So the third one, I'm being told is 74.55. 74.55. 74.55. 73. 73. I'm not seeing so many students really giving me these answers. 73. 72.6. 72.6. 72.6. 72.6. 72.6. Yes. Value of debt. No, value of debt is given by the examiner, right? Value of debt is given by the examiner. Value of debt is given by the examiner. Look at the question itself, GX. All right. All right. So please go to the next one. The next one, what are we getting here, somebody? 80. We took 80.75 minus value of debt, which is 2.5. For 12.5, somebody's getting a different figure, 73.5. 73.5, 82.5. If you take 82.5 minus 12.5, the fourth is 72.5. 1, 2, 3, 4. The fourth is 72.5. So this one is supposed to be 72.5. Great. How about the fifth? How about the fifth? How about the fifth? 72.25, 72.25. Oh, the fifth figure, 70 point, the fifth figure, 70.5. 70.5. The sixth figure, oh, 67. 67. The last figure, 60. The last figure here is 60. I'm being told that this is 70.25. 70.25. Thank you so much. Ladies and gentlemen, let's proceed on. So please give me the weights. Please give me the weight of equity. What shall we do to be able to get the weight of equity? The figures are wrong. The figures are wrong. Like which one? Is the first one correct? Is the first one correct? Yes. Second one, 76 point. Or wrong. Last one is supposed to be 66. I'm told that the last one is the one that is wrong. It's supposed to be 66. 80. I use 66. 80 minus 20 cannot be 66. 80 minus 20 is 60. Why are you getting 66 from? Yeah, it's supposed to be 60 like that. All correct. Thank you very much. So then could you kindly come and give me the weight of equity, please? Please go there and give me the weight of equity. Weight of equity. Silvanus, you must have gotten the last one wrongly here. This is 80, Silvanus, please. This is 80. So how do I get weight of equity? I have the value of equity here, which is 78.25 over the total value. which is 80.75. Somebody is saying that the second last is wrong. 82 minus 15. Even the third is wrong. Wow. What are we subtracting? What are we subtracting? What are we subtracting? What are we subtracting? Okay.
Excuse me, sir.
Yes, Silvanus.
When you are subtracting, are we using MM2 or MM4? Because that's where the confusion is. When you see the figures, yeah, that's where the confusion is.
What does the question talk about? What is the question talking about here? What is the question talking about? Should we use MM2 really or MM4? Read the question. The question should be able to guide us.
Yes, evaluate the firm's optimal capital structures when the financial distress costs are included.
So when they are included, should we use MM2 or MM4?
For me, I think we should use MM2.
Why MM2?
That's why I'm getting the different figures.
But you have just read the question. When financial distress costs are done, what year? Included.
Are included.
So we should use, it's only MM4 which has got financial distress costs. It has to be MM what year? 4 throughout.
The figures are, the first figure is not correct then. The first figure uses MM2.
The first figure used MM2.
Yes.
80.75 minus 2.5 is what, somebody? I think it's supposed to be 78.25. Yeah.
The first one is 8.75. I think my figure was wrong. Anyway, okay. I've seen where the problem was.
Thank you so much. Bye-bye. So, but are the figures here correct? Are the figures here correct? Are the figures here correct? Yes. Now then give us the weight of equity. Please give us the weight of equity very fast now. So weight of equity, we are taking the value of equity divided by the total firm value. Yeah. So somebody is giving me 0.97 here. The first one is 0.97. How about the second one? Second one takes 76.4 divided by 81.4. 0.94. Thank you very much. Please go to the third one. 74.55 divided by the third figure. 0.91. 0.91. Thank you so much. 0.91. The fourth one. 0.88. 0.88. The fifth one. The fifth one. 0.85. Thank you very much. The sixth one, which happens to be the second last. The sixth one, which happens to be the second last, 0.82. And then the very last gives us 0.75. Thank you very much. So then what do you think are we going to do for us to get the WD? What do you think shall we do for us to get WD? WD. Yes, we know that weight of equity and weight of debt must always add up to 1. So in short, what they're telling me is that for me to be able to get to weight of debt, simply talk over 1 minus weight of equity. Across very fast, please give me the figures. Less from 1, thank you very much. So the first one Jabir tells me is 0.03. Thank you so much. Right? 0.06, I've seen somebody giving me 0.06 here. Thank you. How did he get weight of equity? Weight of equity, unfortunately, I've rubbed mine here. We're taking value of equity divided by the total firm value. You can get total firm value by taking this plus 2.5. So take 78.25 divided by bracket 78.25 again plus 2.5, or use the value, total value that we had here. All right. So next one is supposed to be 0. What here? Sorry, 0. The next one 0.09, 0.12, 0.12, 0.15, 0.18, thank you very much. And then lastly, you're supposed to talk of 0.what here, somebody? 0.25, thank you very much. Thank you very much. So ladies and gentlemen, I've been able to get my weights. But remember, Wakaka also needs a few things. WACC is weight of equity, cost of equity, plus weight of debt, cost of debt after tax. I have got no problem now with this at all. Those ones have been given. But how about now cost of equity now? Cost of equity. Hapo ndio kizungumkuti pia wanafunzi hawakuona hizo. Hizo walikuwa mrefu sana. Wajaribu kutwist. Ilikuwa mrefu sana kwa wanafunzi. So how about cost of equity? Cost of equity. Ilikuwa mrefu sana. Ilikuwa kuswali mrefu sana hiyo. How about cost of equity? How about cost of equity? But I hope you're following. The most important thing is for you to follow. Most important thing is for you to follow. So now we are getting the cost of who? Equity. So the first one, I guess yes. Now somebody has told me 17.5, which is very good. But you see, 17.5 was for the farm when it was unlevered. Now this farm, ladies and gentlemen, is levered. The farm is levered. So we need to know how to compute this cost of equity. Remember, when I started this, I gave you a very good formula. There is a very good formula that I gave you here. Kuna formula ambayo nilikupatia mzuri sana. Tukasema EBIT, or rather value of equity equals what here? Somebody, value of equity equals EBIT, talk of minus whatever interest, if it is there, into 1 minus tax, all over what here? Cost of equity, like that. Very important formula that I gave you when we started. All right. So could you kindly make KE the subject of the formula? If I make KE the subject here, then I'm going to swap the two. I'll have here cost of equity equals EBIT minus interest into 1 minus tax, all over value of what here, somebody? Value of equity. All right. So I would want us to calculate a cost of equity at each of these levels. I'm so sorry because I know your space can't allow you, but mine is quite nice. Mine will allow me. Just try to fix it somewhere there. So I want us to calculate cost of equity in each one of them. For each one of these levels. So is there somebody who is able to remember our EBIT? Oh yeah, aki wamechoka. Umechoka tukienda kufika tu, wanataka nyungu yanguke. Yeah, EBIT was 2020. So like the first one, it will be 20 minus, do we have debt? Do we have debt for the first scenario? Do we have debt for the first scenario? Debt is here. Debt is 2.5. Remember debt is 2.5. So 2.5. Do we have the rate of interest? 30% is not the rate of interest. 30% is not the rate of interest. 30% is not the rate of interest. Hebu angalia swali vizuri. 30% is not the rate of interest. The rate of interest ni sawa na KD, isn't it? Hiyo ni sawa na KD. So times 4%. And then multiplied outside here with what here? My board now, I have to squeeze it. 0.7. All over. Are you able to see the value of equity? The first value of equity ni ngapi? Somebody, value of equity. The first value of equity, I have to squeeze my board a little bit. Is 78 point what here? 78.25. 78.25. Is 78.25. Is 78.25. Is 78.25. Right? Yeah. Hebu saidia mwalimu hapa the first cost of equity. Saidia mwalimu the first cost of equity. Nimeona msichana anaitwa Mwikali analia kweli kweli amefloat, and I know why that is the case. Mwikali haja watch videos. When I watch videos ata float, lakini not sana hivyo. There will be those low hanging fruits ukisema unaona jua anastuka anashika. Right? Like if you watch video totally, it becomes an international water disaster. It becomes an international disaster. It becomes an international disaster. So somebody is telling me that the first one is 16 point what year? 16.6. Is 16.6. Aha. Mbona tuna include debt na kwa formula hakuna? Kwa formula hakuna kweli. Kwa formula ni interest. How do you get interest, Abdul, without knowing your debt amount? So what we are doing is to take the debt amount times the rate of interest. Times the rate of interest. Rate of interest. Aya, nifanyeni favor, nipatieni figure ya kwanza kabisa kwanza. Nipatie figure ya kwanza kabisa. What is the first cost of equity? What is the first cost of equity? Wanasema ni 17.8%. Is there anybody who has been able to get the second cost of equity? Second cost of equity. Anybody, through whichever ways. Is there anybody who has been able to get the second cost of equity? Anybody who has been able to get the second cost of equity? 4%. 4% imepeana pale pre-tax cost of debt. Kwa question, kwa ile table, KD. The first is 17, body mass. Use your body mass well. Wanasema use your body mass well. The first is 17. Remember here, the first one, tumesema ni 20 minus debt is 2.5 times 0.04 multiplied by 0.7, and then everything you divide by the value of equity, which is 78.25. So then if you use your body mass well, put brackets there, 20 minus this times 0.04 close times 0.7. Whatever we say equals and get, we divide it by 78.25. Can somebody confirm that this figure is wrong? Is this figure wrong? Somebody is challenging our knowledge of body mass. Somebody is challenging our knowledge of, it's correct. So Silvano is only going to share body mass. Right? It's correct. Ya pili ni ngapi? Somebody, ya pili ni ngapi? Ya pili ni ngapi? Ya pili ni ngapi? Somebody? Ya pili ni 18 point what year? Now, ladies and gentlemen, I don't want to finish this question. I would want somebody to tell me where we have reached. What do you think shall we do for us to be able to get WACC? Or rather, what will be the WACC of the first point? What will be the first point WACC, the first WACC? The first WACC. Very good. There is a student here who has used this very important formula. This very important formula. I used KL equals KU plus KU minus KD, D over E, and got the same answer. Yes. Yes. Very important formula. Very important formula, yes. So what do you think, ladies and gentlemen, shall we do for us to get WACC for the first one? So we know it's weight of equity, cost of equity plus weight of debt, cost of debt into 1 minus taxation. So like now the first one, weight of equity. Do we know the weight of equity? Yes, it is 0.97. Cost of equity, you guys have given me the cost of equity is 17.8%. Do we have the weight of debt? Yes, weight of debt is 0.03. Times cost of debt, you gave me 4%. Cost of debt was 4% pre-tax, so multiplied by 0.7. And this is what I expect you to do for each one of them. Each one of them. And then now you're going to settle for the lowest WACC. The lowest WACC is the one you settle for. And of course, you go by the recommendation of that capital structure. And I would want to leave that question like that. Niwaachie mng'ang'ane nayo, tusonge mbele. Yaani ule alikuwa aone, ameona. Ule alikuwa hajaona, pia tumpatie chance ya kuona swali lingine. Tumpe chance ya kuona swali lingine, tuseme hii haitakuja. But such questions are very good, especially, ladies and gentlemen, when you go to an exam and then you realize that the paper is very hard, when you've got nothing to do. This thing will make you look like a genius in an exam room, because you'll be writing so much and people will be wondering, I mean. Hapo kwa tax, wapi sasa wewe? Wapi? Si ni 1 minus taxation. 1 minus tax is 30%. So 1 minus 0.3 is 0.7. How did we get WE? Bila ningetaka kurudia, but this question imewakalia. Ukishindwa na hii maswali, bahati mbaya. Let's try to increase our scope by looking at other questions. Is that okay? Is that okay? I think that's the best thing to do in the circumstances. Nikianza kurudi tena tulipata WE wapi, itakuwa international disaster. So part A of this question, explain the meaning of the term unbundling as used in corporate restructuring and reorganization. And reorganization. Thank you very much, Duncan. So what is unbundling? You see, to bundle is to put together. To unbundle is to split an organization into many components. So to unbundle, unbundling means what? Here, somebody unbundling is the process of splitting an organization into many sub-units, and selling them. And selling the non-core units for purposes of improving efficiency, and liquidity of the firm, for purposes of improving efficiency and the liquidity of an organization. That's unbundling. That is unbundling. So, and unbundling, we are breaking down our organization. Like if you read last week's Business Daily, they want to unbundle Safaricom. They are realizing that Safaricom has become something that is so huge and it may bring management issues in the near future. So what have they recommended? There is a bill in Parliament where they want to unbundle and then leave Safaricom Telecommunications as a separate entity. And then we have number two, we have M-Pesa as a different entity. And of course, the subsidiary, which will be M-Pesa, will be sold at a very high price, So unbundling is the process of splitting or breaking down an organization into many subunits and selling the non-core units for purposes of improving efficiency and liquidity. Is that clear? Yeah. So could you kindly give me the various forms of unbundling that you know? Part 2, they wanted us to explain the various forms of unbundling. The various forms of unbundling, do you know them? The various forms of unbundling. Various forms of unbundling. Yeah. Sell-offs, thank you very much. Sell-offs, yes. That's number one. And then number 2, wameanza kuamuka sasa. Kuna zile common. Kabla mwanze, kuna zile common. Management buyout, that's quite a common one. Spin-off is very common. Spin-offs, right? Number 3, we have the carve-outs. Number four, I'll talk of management buyout. It's quite a common one, management buyout. Right? Now, ladies and gentlemen, remember, under sell-offs, in this case here, we create a subsidiary. We create a new company. We create a subsidiary and sell and sell all shares to third parties. To third parties. If some parties well within in the company are interested also in buying the shares, we don't also close any doors for anybody. But most important, under sell-offs, we shall create a new company, which will be our subsidiary for the time being. And then we start offloading the shares for purposes of what? Yeah, improving our liquidity status in the company. Is that okay? The Centum model, yes. Yes, Centum is so good at that. Okay, so is this okay? Somebody sell off, selling off. Create a new company like M-Pesa, we sell off all the shares like that. And then now we go to the spin off. So what happens under spin off? What happens under, spin off, you'll create a new subsidiary, right? Thank you very much, yes. And then I have the subsidiary coming back to the old owners, right? So this subsidiary will not get out there, right? This new company, selling of a parent company, no, you don't sell parent companies, you don't sell your parent. Wait. Under spin-off, ladies and gentlemen, we shall be able to create a new company, but this new company will be owned by who? The old shareholders. Will be owned by the existing shareholders, yes. So it is simply spins around. Like now, when they have Safaricom as a share, and then they have a subsidiary called M-Pesa, do you think the existing Safaricom shareholders will be happy to see M-Pesa, which is the biggest brand, which is the major thing, the in thing? Do you think they'll be happy if M-Pesa is sold to outsiders? No. So what shall happen is that they shall create this M-Pesa, but shall be spinned back to the existing owners. So the existing owners will still own M-Pesa. How about a carve-out? So for carve-out, ladies and gentlemen, of course, we create, of course, a new company from an existing company and sell some shares of the new company to outsiders. Some. So we create a new company and then we carve out just something small. We sell. And remember, it can only be called a carve out if the parent company maintains at least 50%. If the parent company maintains at least 50%, then this arrangement becomes a carve out. Otherwise, if they become minority, then that is a sell off. The parent company must maintain, must maintain more than 50% of this new company for us to call it a carve out. Very, very important. How about management? Buyout. Management buyout. So remember, we could be having nope. That's a leveraged management buyout. With debt is a leveraged management buyout. When outside managers, management, we have got management buy-in and management buyout. Yeah. So basically, ladies and gentlemen, here, this is where we create a new company and sell. We create a new company and sell shares to existing managers. They believe in the farm. To existing. So they are basically buying out the current shareholders. So we sell shares to existing what-year managers. We do something small for them. We create a company for them and sell that subsidiary to them for the major company, for the core company to raise what-year to raise capital, to raise capital. Very good. I'm so sure you umepata idea. Ni idea unapata ndio uweze kufanya nini? Kusonga mbele nayo. So for spin-off, what have we said about spin-off? We create a new company, but ensure that this new company's shares are sold to existing shareholders, so that both companies will have the same owners. Will have the same owners. The same company will have the same owners. Great. So straight away we look at question number 1, part C. Question number 1, part C, are we there? 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 It's May 2021. Camera not clear. May 2021, we're doing the same sitting. May 2021, question number 1, part C. Great, great. So have we gotten the question? Have we gotten the question? Have we gotten the question? Dafina, yes. Quite a good name. I would recommend that name for those of you who are still getting children. Ensure that you get a child and name that child, in this case here, who? Dafina. It's a good name. So Dafina Limited is an export-import firm based in Kenya. On August 1st August 2020, the company exported the tea to the USA on a 3-month credit amounting to US dollars 10 million. Additional information, they have given us additional information there. The customer will settle the amount on 1st of December 2020. Great. So there's one there, Dafina, from some high school, who was very rude, so I cannot call my son or my daughter like that. The customer will settle the amount on 1st of December 2020. Using the interest rate parity, determine the expected 3 months forward exchange rate as at 1st December 2020. I'm so sure this question was tested by a lady. This must have been a lady examiner. Why am I saying that? Remember, this particular, ladies and gentlemen, transaction was entered into on 1st August 2020, right? And the payment is being done. The payment is being done on 1st December 2020. So how many months do we have in between there? Are they 3 really? Are they 3? I've never seen any gentleman having a problem with months, counting dates. So this must have been a lady examiner. 4. There are 4. There are 4 months between here. So it was an error. Fortunately, we picked it up very fast, and the students were able to get a kind of a leniency in terms of marking the question. Okay. But here they want us to use interest rate parity. Is there somebody who can remind us the formula of interest rate parity? Mayoma, I can see what you are asking. Forget about those. Concentrate here. Focus here. Focus here. Usifikirie vitu mingi. Ukiwa mwogo unafikiria vitu mingi sana, utakuwa na shida mingi sana in life. Focus here. Yeah. So ameniambia mwalimu, this should be forward rate equals a spot rate into 1 plus interest country C. Interest in country C all over 1 plus interest in country B. So wanafunzi wageni, thank you very much, Mayom. Focus like that. You're doing this question now. Don't think about other questions out there. Let them go to hell. Forward exchange rate equals a spot exchange rate into 1 plus interest rate in country C over 1 plus interest rate of country B. Thank you so much. So in this question, do we have the spot rate? Have they given us the spot rate in this question? Spot rate is that rate that exists at the date of entering into this contract. The prevailing rate at the date of entering in this contract. So that must be the prevailing rate on 1st August 2020. First, great. So then this should be 105 Kenya shillings per dollar. So it is from this portrait that I'll be able to know which country is the numerator country. How they have expressed this thing. I'll be able to know ni country gani ya juu. Ni country gani ya juu. I'll be able to know. I'll be able to know. Kenya shillings ndiko juu. Hapa. Kenya shillings ndiko juu. Kenya shillings over $1. So straight away, it means that I can come and even delete this. Instead of saying interest C, I should say interest Kenya. I should say interest Kenya. I should say here interest USA. Interest USA, like that. Interest USA. Ukishajua ile kwa juu na chini, umepona kabisa. All right. So in this case here, I would want somebody to give me the Kenya's interest rate. Is there somebody in that question who is able to see Kenya's interest rate? Please concentrate here, answer my questions. Kenya's interest rate. Are you able to see Kenya's interest rate? I'm told it's 18%. I'm told it's 18%. So tafadhali, unapoenda kwa exam, hata saizi unaposoma, inafaa unaomba Mungu akupatie macho ya kuona sawa sawa. Usikasome vitu mingi sana ambazo ziko offside. So utapata mwanafunzi amesema hapa ati 1 plus 8. Anaweka bracket vizuri hivyo. Anasema all over 1 plus interest rate in the USA ni ngapi? Somebody kuonyesha makosa wanafunzi wengi hufanya sana. 12%. So nikiwacha hivyo nitapata correct kweli? Nitakuwa correct kweli? Nikiwacha hivyo nitakuwa correct? No. What haven't I included here? Cuprorate, yes. Because these are annual interest rates. These are annual. Thank you very much, Nalong. These are annual interest rates. So kuja hapa sema times 3/12. Times 3/12. Like that. So abracadabra, hapa pia utapata shida sana na nini? Utapata shida sana na body mass. Hapo ukicheza 0. So kuja hapa sema 1 plus 0.18 times 3/12. Kiwezekana uandike answer kando. Tena ufanye hii uandike kando. Right? Ukishafanya of course lazima multiply na 105, Why not 4/12? It's because the examiner spoke of what here? 3 months credit. 3 months credit. Yeye mwenyewe amespecify 3 months credit. So yeah, 4 months you guys are correct, but that's not what the examiner was asking. Although in an exam situation, even if you used 4/12, you are still getting all the marks. CASNEB is very lenient. But here it should be 3 because the examiner kept on insisting 3 months credit. So then what is the final answer? Can somebody give me this final answer? Can somebody give me this final answer? Can somebody give me the final answer? I'm being given 106, 106.53, 106.53. So 106.53 cows. Are they cows? Is it 53 or 23? Are they cows? Are they cows? Kenya shillings per what year? Per US dollar. It's cash per US dollar. Thank you very much. Thank you very much. Thank you very much. There's a student who asked there, how do you get to know it's Kenya which is on top? Very easy. If, for example, you go and get like 30 Uganda shillings per Kenya shilling as the spot. Fidelis, which country is on top here? With this expression, if this is your spot, which country is on top? Which country is on top? Fidelis. Fidelis. Nimrod, you're not Fidelis. Eliza Mushem, you're not Fidelis. I'm talking to Fidelis here. Unfortunately, Fidelis has refused to talk to me. Fidelis Kenya ndio iko juu. Sasa Fidelis kusema ukweli, hii kitu kubwa. Hii angalia, Uganda ndio iko juu. Kenya shilling iko chini. Iko chini. Uzuri wa kukosea ndio kujua njia. Haupo umeona. So vile imekuwa expressed. The fraction. It's quite fractional. You can easily tell the one that is on top. So Fidelis, I'm waiting to get some clearance from you. Whether now you have seen how to know which one is on top. Top down. Thank you very much, George Simiu. Top down. Uganda, yes. Thank you very much. Great. And then now, ladies and gentlemen, from there, they want us determine the expected 3 months forward exchange rate as at 1st December 2020. That we have gotten. And then number 2, using suitable computations, advise the FINA Limited on the better hedging strategy between a forward market and a money market hedge. This is something I swore that I'll never do any question of money markets. I'll never do any question of forward contract with you. I'll only do this question of money market and forward contract with the next semester students. If they test it this time around, that is the question I'll use to revise with the next semester students. And I know that, ladies and gentlemen, you shall not be there. Please do know. No. You shall not be there. Kuna vitu ambao nimeangusha chini, nikaangusha chini proper. Part B of this question. Net present valuation, which has capital rationing. Give us time to calculate B. I give you time to calculate B. I give you problem now. Yeah, nimefanya example mingi sana. Just do it mwalimu. Society utaikuja kufanya lini? Mimi siendi kufanya exam. Na nimefanya example zaidi ya 20 hapa kwa darasa. All right? Do it? No. And post later. The best ni kwamba maybe tupeane video a question. Actually, we did this question in one of the classes, if you remember. I only wanted to remind you guys this concept of what your interest rate parity. Wewe sio ni kama babake yo, wewe ni mwanafunzi wa kitambo sana wangu. For the sake of thank you very much. Hiyo tumeshamaliza. Hiyo mtasema mwalimu ni arrogant, but I know. Wewe tuende kwa part B of this. This one I'll send you videos. I'm 100% sure of that. For money markets and whatever, I'll send you videos. You know, when I know an area will come, what do? I skip it. No, hakuna huruma wewe hapa. I skip it, send a video because I know students will watch it religiously. You have been appointed by Biosoft Limited to review 3 investment project proposals. The investment funds are limited to 8 million in the current financial year. Details of the 3 possible investment projects, none of which can be delayed, are given below. Project 1, an investment of 3 million in workstation assessments. Each assessment would be on an individual employee basis and would lead to a saving in labor costs from an increased efficiency and reduced absenteeism. The same question we are doing part B. 1B, and reduced absenteeism. In money terms, the saving in labor costs are expected to be as follows. So you can see here, 850, 900, 950, 1,000, 950. So ladies and gentlemen, the first thing that I'll do, and before I read the question, I will get net present value for this project. Very easy. Which are the same. We are doing the same paper throughout. May 2021. The same paper throughout. May 2021. May 2021, question number 1B. So project 1. So project 1. So project 1, what do we have there? They have given us cash flows. So they have given us cash flows there. So we have here 1, 2, 3, 4, 5. They have given us here 850. They've given us here 900. They have given us 950. They have given us 1,000. They have given us 950. So these are irregular cash flows. They are irregular cash flows. If they're irregular cash flows, then to discount them, we shall use what we call present value interest factor. We shall use PVIF. Thank you very much. We shall use PVIF. We shall use PVIF. We shall use PVIF. Have they given me the cost of capital? Yes. They have told me down there the money cost of capital, which is the same as nominal cost of capital. This is a good one to use. So the money cost of capital is 12%. Is 12%. So do we have 12% in our tables? Somebody who has got present value interest factor tables, do we have 12%? If yes, kindly read them down for us. Read them for us down. 0.89, 26. And please, if they don't have the table, somebody send a past paper that has that table through our WhatsApp. There could be some students who don't have that table. 0.79, 0.79, 0.79, 12% second year, 12% second year, 12% second year, 79.72, 79.72, 12% third year, 0.7118, 0.7118, 0.7118, 12% 4 years, 63.55, 63.55, 12% 5 years, 56.74, 0.5674. So we want to come here and give them what we call the discounted cash flows, the present values. So present values, what am I doing? Right there, 2 decimal places. 2 decimal places. Could you kindly do that for me? 2 decimal places. 758.71. 758.71. Yes. The second one. Oh, Abdul, I'm part of 7. This and this. It is 758.96. They have repeated. 0.96. All right. All right. So please, how about this and this? 717.48. 717.48. Thank you very much. Thank you very much. And now the third one. The third one. 676.21. Thank you so much. Thank you so much. 635.50. Go the last one. 539.03. Thank you very much. So please come and give me the total present value. The total present value. Total present value, you're adding up everything. Number 1 is 758.71. I want students who are using these 4 decimal places exactly, yeah? Please, if you're using 4 decimal places, how much do you get there? 32, 26.93, 32, 32.71, 32, 27.18, whatever. So come and less the initial outlay. Less the initial outlay. So initial outlay. Is there somebody who is able to remember the initial outlay? In this question, what is the initial outlay? In this question, what is the initial outlay? 3,000. 3,000. So please subtract for you to give us what we call net present value. What are we getting as our net present value? 327.18. Oh, 327. So this figure is wrong. Is this figure wrong? Please give me the correct figure here. Please give me the correct figure here. 33.27. 33. So then this should be 327.18. Thank you so much. And because this is a question of limitation, we have scarcity, a capital constraint. I know such questions here with capital constraints. I must calculate what we call profitability index. I must calculate what we call profitability index, PI. I must calculate PI. Is there anybody who is able to remember the formula of PI? Is there anybody who is able to remember the formula of PI? PI. PI. Its present value, total present value of initial outlay. So there should be total present value we have here, which is 3327.18. You divide this by the initial outlay, which is 3,000. 3,000. Quite a good project. Any project with PI is more than 1 point something. That's a good project. That's a good project. Right? So that gives me what figure somebody there, 1 point. .11. This is quite a good project. Quite a good project. So 1.11 like that. Thank you so much. 1.11, quite a good project. That is project number 1. I'm so sure none of my students would have failed getting NPV of the first project. None of my students. All my students would have gotten NPV of project 1. Can I wrap this? Can I wrap this very fast? Yes. Thank you very much. Then we go to project number 2. We go to project number 2. So project number 2, what do we have there? Project number 2. So project number 2, this is what we have there. Samoi, I can't understand your question there. So project number 2, we are told an investment of 4,500 in individual workstations for staff that is expected to reduce the administration cost by 1,408 per annum in money terms for the next 5 years. So basically that saving is our cash flow. So the cash inflow is 1,408. I could have my figures in thousands. So this is a cash inflow per annum for how many years? For 5 years. So in short, my present value will be this 1,408 times PV for 12%, 5 years. I'm using PV for because this is an annuity. Are we together? Are we together? Are we together up to there? Are we together up to there? Are we together? So ladies and gentlemen, come and give me this PV from your annuity tables. Are you able to see the PV for 5 years, 12%? From your annuity tables is 3.6048. All of us, are we able to get this figure? All of us, 12%. You know, we have got an annuity table and a lump sum table. You need to look at the title up there, annuity. So 3.6048, 3.6048. So is that okay? Great. And therefore, the present value there will be 1,408 times 3.6048 like that, which will end up giving us what figure? 50? 75, 50, 75.56. Because I want net present value, I'll come and say less initial outlay. Less initial outlay over how much? Of 4,500. Of 4,500, which will be able to give me what we call net present value. No, you cannot be penalized by anybody. You can't be penalized by anybody by using a calculator, no. So the PV for the final value, what is it supposed to be? 575, 575.56 like that. Thank you very much. But because it's a question of scarcity, I have to calculate its profitability index. So profitability index equals who? Profitability index equals who? Profitability index equals who? I know it's present value total, 5075.56, divide this by 4,500. So what are you able to get as our profitability index? Yeah, ukiona zinakaribiana sana, try to increase the decimal places. Kama zinakaribiana, so unasema ni 1.13, kama zinakaribiana sana, because I remember the other one was 1.11, zikaribiana sana, take a decimal place mingi. That's okay. Now we go to project number 3. Do we use PV? Yes, we use, in this case here, present value, not NPV. It is present value. It's present value, present value, present value, present. If you use NPV, you will never get figures which go more than 1. Remember, good projects have a present, or rather have a profitability index of more than 1. Great. So from there, we go to project number what here? Project number 3. So project number 3, what is project number 3 all about? So project number 3 was quite an easy one. Project number 3, an investment of 4,500 in new ticket machines. A net cash savings of 1,200 per annum is expected in current money terms and is projected to increase by 3.6 per annum due to inflation during the 5 years life of the machines. So could you do me a favor, kindly calculate the cash flows of this project number 3 for those 5 years. Calculate the cash inflows of project number 3 for those 5 years. Kindly do that for me. So I'm waiting for figures. Yes, I can see figures coming on board. 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 Thank you very much. Thank you very much. Thank you very much. So project number 3. So project number 3. Year 1, I can even start with year 0. 1, 2, 3, 4, 5. So year 0 is today. When they use that word current, current means today. 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 Current money terms. Never forget that. So current means today. So the current, the net cash savings over 1,200, 1,200, 1,200, 1,200 per annum is expected in current money terms, and is projected to increase by 3 points. So then now the whole of the first year, it will be 1,200 times 1.036. Is it 3.6%? Yes, times 1.036. So what figure are you getting here, somebody? 1243.2. 1243.2. So when you go to year number 2, you can choose to take this figure here, you increase it by multiplying it with this, or you stick with this 1,200 times 1.36 squared, whatever. The 1 over amount equals the same principle into 1 plus r raised to n, raised to n, raised to n. Which method is better? The one of bringing this number here, you have it growing, or this one? Which method is better? Okay, so then at the end of the day, please give me figures here. So we have here 12, 87.96. You square, yeah? So come and maintain then the principle times 1.036 cubed. Year 3, 133, 13, 34.33. Thank you very much. Go to year 4. Year 4, we have 1,200 times 1.036 raised to power 4. Please give me a figure. 1382.47. 1382.47. And then now we have 1,200 times 1.36 raised to power 5. Raised to power 5, which will give us 1432.17. Thank you very much. I'm so sure wanafunzi wengi ambao walifanya hii karatasi walianguka question, sababu walianza year 1 wakaka 1,200. Wakaanza kugrow sasa after there. Wakanyoroshwa kweli kweli. So 1.036 natoa wapi? It's because of the 1 plus 3.6%. The growth rate. 1432 point. Or the last one, more than 712, eh? The last one, 12. So now after that, ladies and gentlemen, come and give me the PV figure. And then now remember, ladies and gentlemen, there is no way you can ever start a business and then you start earning at time 0. This, I only put it here for benchmarking purposes. Normally, we get present value out of future cash flows from year 1 moving on. So in this case here, this 0, year 0, 1,200, you're supposed to remove. It's from 1 moving on. Time 0, we are only supposed to have cash outlay where we are investing, right? So PV at 12%. PV at 12%, what do we have here, somebody? We have already these figures. End of year 1, was it 0.8? End of year 1, or was it 0.8? $926, 8926. Thank you very much. End of year 2. 7972. 7972. Thank you very much. End of year 3. 7118, 07118, end of year 4, 6355, 6365, 63, 63, 5674 ndio hii. Hii ya second last, 6355. Thank you very much. So please go ahead there and multiply for us. Go ahead there and multiply for us. $89.29. Inafaa kuwa 0.8926 ama 89.29. 89.26 ama 89.29. It's good you're asking. Oh, Jabir anasema 29. 29, eh? 29. So please go ahead and multiply here very fast. 2 decimal places. What do we have here? 2 decimal places. 2 decimal places. 2 decimal places. What do we have here? 2 decimal places. 2 decimal places. What do we have here? 2 decimal places. 2 decimal places. What do we have here? 2 decimal. So 1110.05. 1110.05. Thank you very much. How about the second one? How about the second one? 1026.76. 1026.76. Thank you very much. Go to the third one. $916.77. Go to the fourth one. 949.77. 949.77. Thank you very much. The last one. 878.49. 878.49. Thank you very much. So please come and add. Give us the total. Third is 949.77. Yes. I hope the fourth one is also correct. I hope the fourth one is correct. 949.77. So is there somebody who is able to give me the total present value? The total present value. Is there somebody who is able to give me the total present value? Total present value. The fourth one is 878. 878.26. Who is giving us a 812.58? 812.58. 916.77 is wrong. Right. I know. You know what you're supposed to do, ladies and gentlemen, please, the figures you're using here, don't use the figure that you got from your calculator. Let's use these 2 decimal places, and these are 4 decimal places. You want us to get the same answers. But unless you tell me that these figures are wrong. So we start from the third one. Can somebody give me the third figure which is correct, where you take this 0.33 times 0.7118, the third figure. The third is 949, 949, the third figure. The third, I want the third figure, the third figure, 949.78. The third figure, I think that's supposed to be the fourth one. The third figure, I want the third figure. Is 916 correct? The third figure, 916, is it correct? The third figure, 916, is it correct? No. So it's supposed to be 949.77. How about the fourth figure? How about the fourth figure? 878.48. 878.48 or 49, that is correct. How about the last one? How about the last figure? How about the last figure? Last figure is 812.58. 812.58. So then could you kindly give us the total figure, total present value? Please give me the total figure. The total present value is 4777, 4777.65. So come here and less the initial outlay. So less the initial outlay. Is there somebody who can remind us what the initial outlay of this question is? What is the initial outlay of this question? 4,500. So the initial outlay is 4,500. So when you subtract, what are you able to get somebody as your net present value? Somebody talk to me tonight. Net present value is 277.65. 277.65. 0.65. Thank you. Beautiful. Great. That's on the board. So are these figures now correct? Are these figures correct? Somebody confirm. You know, I would want this video to be used. I would want this video to be used. Very correct. Thank you so much. So Lucy, you're the one who is using figures which are not on the board. Thank you very much. So how about the profitability index? How about the profitability index? How about the profitability index? Total PV 4807. How about the total PV? Somebody, total PV is what? Total PV. Somebody has brought a very different figure. The total PV. The total PV. Is it correct? Total PV. Yep. So please, you guys, I'm so sure you must have been using the figures you got in your calculator. And I wanted you to use the table. Sorry for that. So come and give us here the profitability index. So profitability index is the total present value, 77.65 over initial outlay of 4,500, which will end up giving us what figure? Somebody there, 1.06. So in this case here, could you kindly rank your projects on the basis of PI? Which project takes number 1? Project 2 is the highest PI, right? 213, yeah? So our projects will be 213. Project 2, they're going to highest PI. Project 1, ndio inafuata. Alafu project 3, ndio ya mwisho. Project 3, ndio ya mwisho. Thank you very much. So could you kindly give me their initial costs? Please give me their initial costs. Initial cost of project 2 is how much? Initial cost of project 2 is 4,500. Initial cost of project 1? 3,000, right? 3,000. Initial cost of project 3? Initial cost of project 3? 4,500. Project 3, 4,500. Thank you so much. So what is the total figure here? What is the total required? What is the total required? The total required. Total amount required if you add the 3, 12,000. And how much do we have in our pocket? What is the total available? What is the total available? What is the total available? 8,000. Remember, our figures are in thousands throughout, eh? Our figures are in terms of thousands. So do we have any deficit? 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 Deficit of how much? 4,000. Deficit of 4,000. So what do we do with this deficit? If, for example, you are the one, and I gave you this example when I was teaching you in the normal class, you are Amze, like myself here. Ladies and gentlemen, you have gone to some tailor there. You and your kids, of course, you had carried the whole world in those trolleys. So you go there, this tailor takes on the goods. In this case here, feeds them, right? Feeds them to the system. And nakwambia mzee unahitaji 28,000. And yet in your pocket uko na 20,000. Fuliza hakuna. Unaweza kuregister fuliza hapo sasa. What you'll do is what Caro is telling us. However sad it will look like, you must, in this case here, find a way of leaving out some things. There are things in this case you have to forget. So in this case here, deficit is 4,000. So, ladies and gentlemen, because remember here we have been told in part 1 that the projects are divisible, eh? The projects are divisible, right? The projects are divisible. The projects are divisible. So I'll come and recover this deficit from these projects upwards. I start with the least, the one that was ranked worst, the one that was ranked last. I recover as much as I can from it. And fortunately, the last project can take care of the 4,000. So minus 4,000. So it means that here, I'm only going to allocate 500 to project number 3. To be able to fit the 8,000, I'm going to allocate only 500, 500. Now, could you kindly give me the net present values? Do you have the net present values? You have the net present values. Project 2, what was the NPV project 2? What was the NPV project? I have to do something here to fit well within my bill, within my budget. Na hapo kijana akijaribu kuongea ngwe, unafanya namna gani kama mzee? Dadi usirudishe hiyo we. Na sasa tumepanga line nyuma yangu. International disaster. They're not giving me NPVs, and my next class is beginning in the next few minutes. So niambia mwalimu, hii ni 505, 575 for project 2, for project 575.56. How about NPV for project 1? NPV for project 1. NPV for project 1, 327.19. 327.19. How about NPV for project 3? NPV for project 3. $277.65. 277.65. Thank you, and thank you very much. But remember, for project 3, these 277.65 came about when you were investing a whole 4,500. Now we have reduced the budget. So it means that for project 3, we must prorate this NPV. So how do I prorate this? And I should take this times what over what? How do I prorate this? I should take this times what over what? Very good. Times the new budgeted amount, which is 500, divided by the old 4,500. So then could you kindly give me a figure now here for the resultant NPV of project 3? I'm being told it's 30.85, 30.85. And therefore the total NPV, please now, the total NPV will be equal to who? The total NPV will be equal to who at the end of the day? Please add the 3. We have this plus now this reduced one. The one that was affected by this limitation, the one that was affected because of the limitation is project number what here? Project number 3. Mayom is asking, why do we prorate this one and not the others? Can somebody help me answer that? Why do we prorate 3 and not the others? Why do we prorate the 3rd project and not the others? Mayom, as you can see evidently here, the other projects have not been affected. Yeah. The shortfall here only affected project number 3. So now we can't afford to put up the whole of project 3. So we have to apportion it because of the revised budgetary allocation. Thank you very much, ladies and gentlemen. It has been a pleasure hosting you tonight. See you next time. Bye-bye.